Robschild. No investment advice. Welcome to the Daily Reminder Review. Today is January 10th, 2025. First daily reminder, the 3-month 10-year Treasury yields were inverted for over 2 years. The last time it happened like this was right before the Great Depression. This alone says, uh-oh. In more recent history, the 10-year minus 3-month, when you get below the black line, in other words, below zero, where the Fed is purposely strangling the economy, once they're done strangling the economy, it's because they know we're headed into a recession. And it happened in 1990. It happened in the dot-com bust, negative right before the great financial crisis. So deeply negative, right? That's nothing compared to what we just had for 2 entire years, suggesting that we may be headed into one of the worst global economic slowdowns of all time. Creepily, the normalization occurred December 13th, Friday the 13th. The 10-year break-even inflation rate. This is the debt markets saying, okay, how much do we bet inflation's going to be over the next 10 years? Although you've maybe been hearing some folks out there saying, oh, inflation is just going to keep going higher and it's out of control. Yeah, maybe, but we're not pricing that yet. And when we do, maybe it'll be more notable. But as it stands, for over 2 years, we've been waffling around between 2 and 2.6% only. Third daily reminder, the SOM rule was triggered July of 2024. This is when unemployment rate, the percentage of people that say, I want a job and I can't get a job, when it bottoms and then it starts going up enough, I believe it's 0.5%, it triggers the SOM rule, and that has marked every recession in modern history. Although unemployment is only at 4.1%, that rise suggests that, again, just another indication that a big slowdown is coming. Although, as it stands as of today, initial jobless claims is still steady until this starts really like picking up and accelerating. We're not actually in the storm yet. On the Fed website, the unemployment rate actually today came out with the 4.1 number. As you can see, this chart goes back to 1950. Every time it starts going up and accelerating up, though, that's when we are in a recession. Curling up, accelerating up, curling up, accelerating up, curling up, accelerating up. Every time we bottom, we start going up, goes straight into a recession. What does it look like at the end of this chart here? Does this look friendly? Does this look like we're just going to go sideways or lower? Not to my eye. Next daily reminder, the S&P 500 is extremely expensive as of the recording of this video. The PE ratio of the S&P 500 is 30, and the Cape-Shiller index ratio is 38. The number that the PE ratio represents is the amount that you have to pay for stocks that gives you $1 of return. Sometimes the market offers stocks at a price of only $6 or $7 for $1 of return to those companies per year, and sometimes it gets much more expensive than that. As it stands today, it costs $30 for $1 of return. Many people over the past few decades have suggested that higher PE ratios are around to stay because, our financial system is just that great and therefore stocks are just worth more somehow. Yeah, I don't know. But anyway, some of these spikes, by the way, that you see going ridiculously high are because of earnings contraction. When companies earn less money, then obviously the price goes way up compared to that return you can get. And we haven't seen that earnings contraction yet. The chart I like to look at for this is macro trends showing the S&P 500 earnings 90-year historical chart. As you can see, the orange line is the earnings of the S&P 500, and sometimes it goes way down. That's like bad. That's like recession. And then sometimes it goes up. That means companies are earning more money. So Some of those spikes on that chart of the PE ratio were when the earnings were going down. Now, what do we have more recently? If I zoom into this, the price of the S&P 500 going higher and higher and higher and higher, while earnings is just staying flat. This is not healthy. This is stocks getting insanely expensive. This is like, you know, if the economy is able to like do something like stop exactly on the dime and get it just right, well then maybe the price could potentially make sense. But the amount of risk out there, paying as much as you have to pay to buy stocks right now, is by historical standards extremely ridiculous and extremely expensive. So much so that even Warren Buffett himself has more cash than he's ever had in his entire life, because he understands that valuations matter, and the price of the S&P 500 and the price of stocks. Although in meetings he'll say out one side of his mouth that price doesn't matter, when Benjamin Graham taught him good. No, they do matter. Another way to look at this, as I mentioned, is the Shiller PE ratio, or otherwise known as the Cape-Shiller ratio. This is a price-earnings ratio based on average inflation-adjusted earnings from the previous 10 years, known as the Cape ratio or the Shiller PE ratio. And as you can see on this chart, in 1929, things got a little expensive, peaking at 31. And that's when stocks got so expensive that you weren't to see returns in your stocks for several decades. And where are we right now? We are at 38, extremely, extremely expensive. One of the excuses for PE ratios being so high is lower bond yields. I mean, after all, if bonds are only yielding 1% or lower, then, a higher PE ratio can make sense. You're going to have to pay more, to get a smaller return. Makes sense if bond yields are really low. What are bond yields today? They're sitting around 5% now. As of the last update of this, my daily reminders show, I had 4% sitting in there for a while, and we've recently risen all the way to 5%, all while the S&P 500 is staying at these insane valuations. This is not going to end well, in my strong estimation. Next item, junk bond credit spreads are at historic tightness. On the Fred website, you can find this yourself, high yield index option adjusted spread. Basically, this is how much does your neighbor have to pay more than the government. I mean, to borrow your money. Let's say you're going to lend your money out. Well, don't you want a higher rate of return if you're going to have a little bit more risk? Well, yeah, you do. Well, sometimes people don't think that there is any risk, and that's when high yield corporate bonds can become only, below 3% difference between that and treasuries. During not so good times, they can yield as much as 10%, I believe. Let's zoom out on this. Can I zoom out? Here we go. As much as 20% above treasury rates. It is very strange and rare for credit spreads to get below 3%, and yet we are here, suggesting there may be a lot of complacency in markets. The rate cut cycle began September through December, cutting off 100 basis points so far. We'll see how much further we'll go with that. Another item, the home price to income ratio is at record highs. Homes have never been more expensive. Looking at this website, longtermtrends.net, home price to income ratio, taking median household income and comparing it. Well, how many years does the median household have to work in order to pay for a home, in order to buy a home? Well, the great financial crisis, when homes were getting insanely too expensive, it was at 6.8 years, and right now it's at 7.25 years. What could possibly go wrong? Last daily reminder, the leading indicators are collapsing. Looking at tradingeconomics.com, we find this chart. The Conference Board Leading Economic Index is a predictive variable that anticipates or leads turning points in the business cycle by about 7 months. The 10 components of them include average weekly hours in manufacturing, average weekly initial claims for unemployment insurance, manufacturer new orders for consumer goods and materials, ISM index of new orders, manufacturers new orders for non-defense capital goods excluding aircraft orders, building permits for new private housing units, S&P 500 index of stock prices, leading credit index, interest rate spread, 10-year minus federal funds rate, and average consumer expectations for business conditions. Well, every single time this goes down, it's during a recession. It's during not so good times. And what has it been doing since mid 2022? It has been going down and down and down and down, suggesting just another sign out there that we are like facing the storm. So what are my conclusions? Well, my crystal ball says that the S&P 500 is currently priced like it's a Ponzi scheme, relying only on other people to pay a higher price tomorrow than what they paid for it today. This is not a healthy market. This has no value behind it. This is a highly speculative market. This is gambling. This is not investing. Buying stocks right now is gambling. It is not investing. There is a bear market developing with 1.5 million indicators saying we're headed into a slowdown. I am of the personal belief that the Fed won't cut fast enough to save the economy. As much as they hiked rates to slow down inflation, and it didn't slow down because of having massive fiscal deficits, when we cut, it equally will not have the kind of effect that people expect. The Robschild portfolio, therefore, sits around 50%, 57% in long-duration Treasury bonds using the funds TLT0Z and TMF. I forgot to get rid of this. This is no longer valid. This chart pattern is gone. The TNX, I might talk about that on the daily show today later. 9% of the portfolio is in Brazil, a highly undervalued equity market. The dividend yield on this alone makes it an extremely attractive place to be. My favorite funds are EWZ, EWZS, and a leveraged version of Brazil with BRZU. China, I have 13% sitting in China, another massively undervalued market, in my opinion. I don't think that we could possibly have more fear over investing than China, making it a very attractive place for me to be, with 13% sitting in KWeb and a little bit in CWeb, which is a leveraged version of Chinese tech stocks. By valuation standards, they're enormously undervalued. I also have 5% sitting in Nissan stock based on the fact that I believe that their balance sheet is very good and it performed well during the .com crash. I think partly because some people out there will always buy new cars, and when they're trying to save a little bit, well, Nissan. But it's mostly a play, actually a Benjamin Graham play, on the fact that the balance sheet is so strong. They have so much stuff that if you were to liquidate the whole company right now, I believe the stockholders would be paid pretty well, handsomely. It's a handsome reward sitting there, in my estimation. I also have 6% in rare earth metals in a fund called REMX because I believe this is a long underinvested area. This is companies that get lithium, cobalt, anything to do with batteries and magnets and other rare earth metals. This fund mines those things. I believe it's one of the it's one of the most undervalued areas of investment. I now have 5% in cash, moving to T-bonds. This is an update from my last macro show. I had been shorting SMH, the semiconductor index. That arm, the shoulder is just getting too long for me. I don't know what Mr. Market's going to do from here. And, although I fully expect it to lose value, especially over the long run. You know, as much as overvalued something can get, no one can stop Mr. Market from deciding to make the price go higher and higher. So I was able to make a very good profit on that, and I'm out in cash now. And I see the more attractive opportunity T-bonds. With yield sitting around 5% right now, amazing place to be in my estimation. I also have 2% of my portfolio sitting in put contracts, leaps on junk bonds, HYG. This is a play on the fact that, if rates continue higher, that's automatically strangling companies that are going to have to pay more and more, and then that puts more weight on them. And credit spreads can't stay that tight forever. They just can't. The with that much higher risk in their borrowing, love this position. And then a 3% of other things, including a little video game company that I love, and MSOS, because I don't think there could possibly be any more fear in the cannabis industry than there already is, and I don't believe this industry is going to completely vanish off the face of the planet, even though it's priced as if it will. That's all from me and my crystal ball with my macro show. If you enjoy watching, feel free to support with your 2 cents or a like. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.